This video explains how to calculate Part 4 tax, the dividend refund amount, and how Part 4 tax affects the balance in the RDTOH account. As you recall, dividends are included in corporate net income for Part 1 tax and then deducted to arrive at taxable income, so companies don't pay Part 1 tax on dividends. Part 4 tax is the tax paid by private corporations on taxable dividends. How those dividends are taxed depends on whether the dividends were paid by a connected or a non-connected company. To paraphrase Section 186, subsection 4, paragraph B, a payer corporation is connected with a particular corporation if the particular corporation owned more than 10% of the voting share capital and more than 10% of the fair market value of all issued shares of the payer corporation. This is referred to more commonly as more than 10% of the votes and values. To illustrate this concept, consider this structure. A, B, and C are private companies. D is publicly owned. A is connected with C because A owns more than 10% of C's votes and values. B is not connected with C because B only owns 10% of C. B needs to own more than 10% to be connected with C. If B owned 11, for example, B would be connected with C. C is not connected with D because C only owns 1% of D. Whether C and D are connected does not have anything to do with whether D is a private company. Private and public companies can be connected or not connected. It all depends on how much one owns of the other. Part 4 tax is refundable when the corporation pays out a dividend. The Part 4 tax is added to the balance in the RDTOH account. This RDTOH account balance is used in the calculation of the dividend refund. The dividend refund received is equal to the lesser of the balance in the RDTOH account and 1/3 of the dividend paid out. So how do we calculate Part 4 tax? Part 4 tax is equal to the proportionate amount of the payer's dividend refund when a dividend is received from a connected company, and it's equal to 1/3 of the taxable dividend received when the dividend is received from a non-connected company. So the amount of Part 4 tax depends on whether the company that's paying the dividend is connected to the company receiving the dividend. Let's see how this works in practice using that example corporate structure. D pays a $100,000 dividend. C owns 1% of D, so C receives a dividend of 1% of that $100,000, which equals $1,000. C is going to pay a dividend as well. C will pay a dividend of $1,000. A owns 90% of C, so A receives $900 from C. B owns 10%, so B receives 10% from C. So who pays Part 4 tax and how much do they pay? Let's start at the bottom and work our way up. How much Part 4 tax does D pay? D paid C a taxable dividend of $1,000. D doesn't pay any Part 4 tax because D is a public company. Remember, Part 4 tax is a tax paid by private companies on taxable dividends received. How about C, who received a $1,000 dividend from D? How much Part 4 tax does C pay? C and D are not connected, so C pays Part 4 tax equal to 1/3 of the dividend received from D, the non-connected corporation. So 1/3 of $1,000 is $333. That's C's Part 4 tax. C's RDTOH balance has $333 added to it, the amount equal to the Part 4 tax. C also will receive a dividend refund when C pays the taxable dividend to A and B. C's dividend refund is the lesser of 1/3 of the dividend that C is paying. C paid $1,000 in total, $900 to A and $100 to B, so 1/3 of $1,000 is $333. But the dividend refund is the lesser of that and the balance in the RDTOH account. Well, the RDTOH account balance, assuming it started at 0, has been increased by $333, the amount of the Part 4 tax that C paid. So these two numbers equal each other, so the dividend refund is $333. So the net effect of this is that C pays Part 4 tax of $333 but receives a dividend refund of $333. So C's net tax is 0. Effectively, C paid the dividend it received up the chain to its parent companies, so C shouldn't be paying Part 4 tax anyway. And what about A and B? A received a $900 dividend from C, and B received $100. So C paid $1,000 in total, A received 90%, and B received 10%. Because A and C are connected, A pays Part 4 tax equal to A's proportionate amount of C's dividend refund. Remember, C's dividend refund was $333. So 90%, which is A's ownership in C, times C's dividend refund of $333 is $300. So A's Part 4 tax is equal to $300, and A's RDTOH account is increased by that same amount. B received $100 from C, and B and C are not connected. So B's Part 4 tax is equal to 1/3 of B's dividend that they received from C. So 1/3 of $100 is $33. So B's Part 4 tax is $33, and B's RDTOH account is also increased by that same amount. You'll notice that these two numbers add up to all of the Part 4 tax that C would have paid if they hadn't paid the dividend up the chain. So can A and B receive a dividend refund? Yes, they can. When A and B, or one of them, pays a taxable dividend to their respective owners, they will also receive a dividend refund, and that dividend refund will be equal to the lesser of 1/3 of the dividend they pay, the taxable dividend, and the balance in their RDTOH account.